Okay, we're good.
No bathroom breaks.
Okay, okay, got it. Just like, do we have quorum? Okay,
Spare.
okay. Good morning, and we will call to order the Oklahoma City MAPS Investment and Operating Trust meeting for May 20th, 2024. Our first item of business is approval of, can I do those together? Okay. Both the February 19th MAPS Trust meeting as well as March 11th special meeting minutes. If anybody has any changes or corrections, if not, I would take a motion in a second for both sets. Please cast your votes. The motion passes. Thank you. Okay, moving on to item 3, items for individual consideration. 3A, receive monthly investment report for February 29th, 2024, March 31st, 2024, and April 30th, 2024. Doug, welcome.
Good morning, Madam Chairperson. Hope everybody got a good night's sleep last night through the storms.
Gosh. Hope you didn't have to drive through much this morning.
No, not too much. Once I got out of my neighborhood, all the branches and leaves on the ground, everything was okay. But everything's
It is
fine.
spring in Oklahoma.
Yeah, absolutely. Absolutely. I was telling Laura that there's a niche on YouTube of semi-professional meteorologists and storm chasers, and I've learned way too much about that over the past couple of weeks. And every time I tune in the morning and they're like, we're in Oklahoma today, the storm chasers, I'm like, not again.
No, yeah.
Not again. Fingers crossed.
Yeah.
So 1, good morning, everybody. 2, the new logo. You can see that we are rebranded now, Mariner. And if you have any questions about the logo or the background on this, I don't have really good answers for it. The printer works okay. They are not ghosts. It's supposed to be motion and speed and activity is what is supposed to be the message on that. So first, we're going to go through the April 30th report. We can do the March 31st and the February 29th. I think those are not necessary, but I'd like to also talk about the March 31st full performance report, the quarterly performance report in depth. So looking at the market environment, you can see that the month of April is not a great one, but the first 3 months of the year were pretty strong. Trailing year results for equities up 22%, right? We're invested in equities, so that's very good for us. Look down below that, fixed income index returns. We're still struggling in fixed income. Interest rates were up during the month of April, and you can see losses across the board for those bond indexes, but I think that we probably don't have a lot further to go higher. And we've been able to take advantage of some of those higher interest rates through some of the intermediate term investment moves that we have made. If you look at the bottom on the left-hand side, year-to-date sector returns, you can see that consumer services, energy, financials, industrials, information technology, all really strong results. The S&P up 6%. Real estate is the laggard. You can see that down 9%. The real estate sector in the United States is in a pretty tough spot. Work from home has hollowed out industrial or office central business districts throughout the country. I was talking to one of my colleagues this morning who's in Pittsburgh, and he told me that Pittsburgh has passed a law saying that if you buy office property in the central business district, no property taxes for 10 years. So they are getting very serious about this in places. And with the higher interest rates that we have seen because of inflation in the Federal Reserve, operating costs for real estate have gone up about 3x, or the financing costs have gone up 3x, and that's a pretty tough way to make a living right now. Looking at the right-hand side, 2023 sector returns, it was a great year for technology, and thankfully we've had a pretty decent exposure to that. So any questions on this? One final thing, oil, $81.93 a barrel at the end of February. So it's up there. Brent is a little bit higher than that. Natural gas stays low. And again, I think that it does bear repeating that the United States is now the largest oil producer in the world. We went from 5 million barrels a day production about 15 years ago to 13 million barrels a day production today. So we are bigger than Saudi Arabia, we're bigger than Russia, and it's an interesting change that we have seen. So going to the following slide, this is the one that I pay so much attention to. You can see that the net cash flow is the gray mountain, is what some people call this, but you can see that there have been 2.5 really infusions of capital into this, one at the beginning. The blue line is the market value of the assets. So market value was below for some time. You can see mid-year last year, we got a little bit higher, but as we stand here today, the contributions is $115 million, and the ending market value is 121.7. So that's good. That means that we are above principal, and the operating agreement or the operational guidelines of this trust is that once you are above principal, you can make use of some of the funds. So we're in a good spot. Inception to date return 4.58%, and we continue to compound on that as we go forward. Looking at the market value here, this has changed pretty significantly, especially when we look at the 331 report. This will be much clearer, but you see that the domestic equity is 45.3%. The international equity is 8.1%. And you can see that the fixed income plus cash is about 46 or 47%. Keeping the cash, I think it's a great idea to keep 4% in cash at all times, if that is our spending policy, because what that allows us to do is shield 1 year spending at least from market volatility. And that's both fixed income market volatility, which has been unusually large, and then equity volatility. I just want to remind everyone, every 3 years, on average, we will see a drawdown in the equity market of about 20% intra-year. That's just how volatility works in the equity markets. We should expect to see a drawdown of 2 to 3% in fixed income. And again, that's much lower, but for that market, it is very significant. And we are through, just barely, about the worst 3-year stretch that fixed income has seen in decades because of rising interest rates. Any questions about the asset allocation? We look at performance here, very high level, the total fund, net of fees, it's the same as the gross because it's all deducted, 9.4% for the year ended March 31st. We look down the list, domestic equity is up 19.55. These are all index funds on the domestic equity side. S&P 500 index 22.66 was the best return. We did have some volatility where we lead switched several times during the year. Our mid cap and our small cap were both up better than 15%. All three of those are tracking their benchmark accurately. When we look at the international equity, that benchmark does move around. It's a lot tougher to replicate, but that was international equity at 8% of the portfolio, was up 8.44%. And when we look at fixed income, it's a real tale of two different portfolios. The Dodge & Cox is the core, right? It tends to be much higher quality. It was positive at 0.94%, and that number in parentheses next to that, 11, means that they ranked in the 11th percentile of their peer universe. They outperformed 89% of their peers. They were positive while their index was modestly negative over that year. So they outperformed by 250 basis points. That's fantastic rate of return. And then we look at the high yield fund that's managed by PGIM. They were up 8.09%. Lower credit quality bonds, because of the yield support that they had, performed much, much better. And then you see our cash composite, 5.3%, roughly midpoint between the core bond portfolio and the high yield bond portfolio. So any questions about performance? I want to go to one final slide here. We changed the way that we account for the portfolios. Given the fact that you are looking at them differently, we are changing the way that we account for them also. You can see the total market value is $121 million. This slide shows where those dollars are allocated amongst the funds, the mutual funds, and it also shows how they are allocated amongst the underlying vehicles, or the underlying project trusts or project portfolios. But we are not going to be showing individual performance for the underlying projects, given the fact that we level set all of them when we did rebalance the portfolio. So that is the April 30th report.
Okay. Thank you. Any questions for Doug? Okay. If not, I would take a motion and a second to receive that financial report. Please cast your votes. Motion passes. Thank you. And then moving on to item 3B, the quarterly investment report, which was also embedded in what Doug just shared with us.
Perfect. So you will notice that we were very busy towards the end of March and April. And I want to compliment staff, which was very helpful. And I also want to compliment Bank of Oklahoma because they did a fine job helping us rebalance this. It's a very complicated task to go from where we were to where we are today. So there are a lot of transactions, a lot of phone calls, a lot of spreadsheets, but we did make it happen. I'm not going to talk too much about performance. You can see here $125 million, and then the market value of 115, or the contribution level of 115 million. So as of the end of March, we were above. Remember, we're stepping back a month here, so a little unusual. At the end of March, the annualized rate of return was 7.87. I'm interested in also on the number on the far right-hand side. Total contribution of $115 million has produced $5.3 million in income. That's great. And I think income is going to be part of our return stream going forward, much more than it has been in the past. Market value, you can see here as of 6 of 23, we increased cash in the portfolio, remember 1 year ago, because we went to be pretty conservative, and that turned out to be a good decision. But once we solved for how we're going to account for the returns of all of the portfolios, we moved it back into the market. And remember, when we moved into cash, that was a 6-month to a 1-year time frame on that. And as of the earliest days of April, we're back to the fully invested portfolio. So right here, it shows 32% in cash. And remember, we're down to 4% as of the end of April. So there were some pretty significant changes done to the portfolios. You can see here the asset allocation with the large cash component, and that has been rebalanced pro rata to our long-term target asset allocation. And also, at the same time, we equalized all of the portfolios because the cash existed in only the second, well, for the most part, in the second round of funding for the project trusts. So not only did we rebalance the cash away, we rebalanced all the portfolios to look the same going forward. Again, you see the little red triangles here. That means that we were out of our target asset allocation. Again, that was done temporarily. We had the ability to do so by investment policy because of unusual market conditions. Something that we will be talking about going forward is possibly the alternatives in the real estate. I want to stay liquid for the time being. I'm not going to rush any of this, but I think that over time, if this is going to be a 60-year trust, that we might be able to take advantage of some of the liquidity premium in some of these asset categories. But again, that's a gradual process. You see that we have current allocation of 0% to alternatives and 0% to real estate. Our minimum allocation by policy, although we have the out language on that, is 2.5% for alts and 3% for real estate. Again, we want to be buying these asset classes when other folks are selling them because we have a very long time frame. And that gives us a good amount of, I call it private market versus public market arbitrage that we'll be able to take advantage of. At this point, you can see where the allocations were as of March 31st. You can see that several of these, well, all of them produced income, right? All of them produced income. Not all of them produced appreciation or depreciation because the ones that were 100% in cash, that doesn't appreciate, right? It pays interest. So that's what these dashes here on the appreciation, depreciation tell you. And remember, as we were looking at all of the individual project portfolios earlier on this year, the performance of the first round of funds was initially negative, but then the second round we held in cash. They converged to be very, very close to one another. So it was the right time to do it. If we look over the trailing one-year rate of return, 13.57% as of March 31st. That's fantastic. That puts us at 3% since inception. And remember, when we started investing this, it was a few days after, about a month after, Russia invaded Ukraine and kicked off some market volatility there that unfortunately came at the very early stages, but I think we're past that now. Looking at the total return down the list, you can see our index funds are tracking very closely. The index fund for international equity, there's more volatility in there, more variability, so it's trailing, but it's still performing adequately. And then our fixed income portfolios, positive and above the benchmark for Dodge & Cox, positive, and below benchmark for the PGIM, and I'm okay with that for structural market reasons. I think I want to go to this slide. This is the expenses, investment management expenses of the underlying vehicles. You can see that the total investment management expense for the $125.5 million is $141,000. It's 11 basis points. So we're getting fantastic performance for very low costs, very low costs. I think that in the future, looking forward, try to be ahead of the market. We might see some active management opportunities out in the world. We might see some opportunities for some of the more alternative type assets, but favoring more liquid, less complicated structures out there. So very, very solid fee profile for the trust. And again, we don't have a lot of figures on here. You see a lot of NAs on the right-hand side for the compliance checklist because we don't have trailing 3- and 5-year results. This is what it would tell you. We do have some yeses and some no on the individual funds. That should be expected. The only one that's positive across the board is Dodge & Cox, and this is versus their policy guidelines. That's unusual, but again, we're keeping a very close eye on these managers.
Doug, why are the fees estimated? Do they
Pardon?
change? Why are the fees estimated? Do they change based on our asset levels or?
Well, no, it does change for the asset allocation, right? If you look at this, the pre-rebalancing versus post-rebalancing, it will change. And what we're doing is we're taking the current fee, those don't change very often, right? You see how low those are. The market value that we use to weight the individual fees does. So we say estimated because we're looking out, okay, so if this asset allocation, what would have the expenses been over the last year? Because nobody sends a bill for mutual fund fees, right? It's just deducted on a regular basis from the market value, so we can't say exactly how much it was. I wish we could, but we can't.
Okay, anything else? Any other questions? Okay,
Thank you.
thank you very much. So we have a motion and a second to receive the quarterly report. Please cast your votes. Motion passes. Thank you. Moving on to item C3, ratify claims from March 20th, 2024 to March 26th, 2024. Let me get that open here. Okay, we have a motion and a second. Please cast your votes. Motion passes. Thank you. Moving on to item 3D, amendment number 2 and restated audit contract with Allen Gibbs & Co. Houklin? Howlick. Okay. Okay. Any questions? Okay. Okay, the motion passes. Thank you. Moving on to item 3E, discussion of the operator's request for distribution of funds. Matt?
All right, well, good morning. I acknowledge that this process has been extremely fluid, as this is a brand new trust, and everything we're doing for the first time. And we've had some changes along the way, but despite the adjustments that we've taken, we're confident that we're moving towards making well-informed and solid decisions that support the long-term objectives of the trust. Let's see, we can go ahead. Another timeline. It seems like I'm giving timelines every time I come and talk to you, but I think it's good to rehash where we've been and where we are going. On February 19th, for our regularly scheduled February meeting, the trust authorized the investment consultant to rebalance the investment portfolio to align with the target asset allocation, which is why Doug stepped out of his typical order and did the monthly first before he did the quarterly, because as of March 31st, we did not have the final rebalancing, but that took place on April 2nd is when we worked with Mariner and BOK to facilitate that. And I would echo Doug's sentiments that I really do appreciate the partnership with BOK and with Mariner, because it was a complicated set of transactions, and it worked extremely well. So I just wanted to compliment both of those vendors on accomplishing that. And now, as you saw in Doug's presentation on April 30th, the rebalance is reflected in that April report, which now brings us to the disbursement request. During our special meeting in March, the body authorized a $2.2 million disbursement. Now, that does not guarantee that each one of the operators will take all of what has been authorized, but that is the amount that the trust has set. I will note that this is going to be much less complicated than future years because, as Doug pointed out, we have a 4% cash in all of our projects. And so even if there was every one of these operators elected to take their disbursement, we would have enough cash to cover that, so there would be no additional investment sales. It could come straight from our cash allocation. As city staff worked with the chair and vice chair in the city manager's office, as Craig Freeman's the general manager of this trust, it was decided that it would be more efficient to administer these operating agreements by having the operators contract directly with either the City of Oklahoma City or one of the related trusts. This was more efficient for a couple of reasons, but a lot of it had to do with the budget authority, with those operating agreements that were already in existence, and it just made it smoother from that aspect. That also kept this body approving primarily investment-related decisions. And so how the process is going to work, the operator will send the disbursement request to the city entity. And just to make an example, because I know this can be confusing, that I'll take the Innovation District as one. We'll have an agreement with the Oklahoma City Economic Development Trust. And so that request will come directly from the operator to the Economic Development Trust. If you want a picture of what that looks like, here's a copy of the disbursement request form that we've sent. So we've given copies of these to all of our partners within both the city and the related trusts. So the Parks Department has one because the Parks Department and the OCPPA is managing a few of these operating agreements, and the Economic Development Trust has this as well. And this is the form that they would utilize to make that request. And they are aware of those amounts that have been requested for the various projects, and they are communicating that with the individual operators. Now, those operators can request those disbursements based on the amounts that were approved during our March 11th special meeting. And the trust would then send the funds to the city entity for the disbursement on the terms of the operating agreement, because each one of these operating agreements is slightly different based on the allocation, how it's done, and a lot of that comes down to the original MAPS 4 resolution, but also the individual operating agreements. I will note that we will most likely need to have a special meeting sometime in the coming months. With working with the municipal counselor's office, we will have to submit a memorandum of understanding in order to authorize the trust to send those funds to the city. And Laura, does that cover that?
Yeah, that's accurate. So there needs to be something in writing authorizing the transfer of the ACMIAT funds to the applicable trust, whether it's EDT or OCPPA, that all needs to be papered up.
Got it, okay.
And so if those funds are requested and needed before our next regularly scheduled meeting, we will need to have a special meeting to accommodate that, but that is something that we can do for those operators if needing those funds. Any funds that are not dispersed in FY25 will remain invested in the portfolio. And Vice Chair Bryant, our CFO, could not be here today, but one of the things that was important to him was to communicate what is it going to look like in our investment portfolio if we have some projects that take disbursements and others that do not. And so we came up with an extremely simple example, and I want to tell you that this is bare bones, very simple assumptions, but hopefully it can paint the picture of what this could look like. And so in this hypothetical, we have 3 projects that each begin with $10 million. So project 1, 2, and 3 each have a 1/3 share of the investment portfolio in this hypothetical example. And they also earn 5% each year on the investments, and then the trust would approve a 4% allocation each year. Our third assumption is that Project 1 will always take the full allocation, Project 2 will take 50% of the allocation that they're authorized to take, and Project 3 will leave their funds invested. So if you go look at the top table, you'll see year 1. And you see those that you have the 3 projects, each having a share of 1/3 of the total portfolio. With 5% earnings on that portfolio, each earned about $500,000. And then the trustees would then approve 4%. So there was an authorization total of $1.26 million, but that would be $420,000 per project. And per the assumptions there on that dispersed column, Project 1 takes the full 420, Project 2 takes 210,000, Project 3 leaves it all invested. What you'll note is then the ending share is that it's no longer 1/3, 1/3, 1/3, because Project 1 has a smaller percentage, Project 3 has a slightly larger percentage. Taking those same assumptions into year 2, if you go over to the 5% earnings column, you'll note that the investment earnings will be higher for Project 3, who had the higher balance because they left their amounts fully invested, which also gives them a higher allocation amount. However, they still do not elect to take it. So Project 1 will take $423,000, Project 2, $216,000, and Project 3 doesn't have anything dispersed. Leaving an ending balance where by the end of year 2, Project 1 now has just under 32% of the total portfolio, and Project 3 has 34.7%. I know this is an overly simplified example, but one of the things that we wanted to do was to emphasize going forward year after year, there will be some of these operators who will not take their disbursement for a number of years. There are some that will need them in these earlier years, and it will impact our overall portfolio, how it is split up. It's an extremely simple example, but hopefully it gets the point across of what this could look like in the long term, as the reality is with the 9 projects that we have, they are going to elect taking their disbursements at completely different times based on the needs of the operators and what the purpose of those were. For a good example would be the youth centers between the operating side and the capital side. Those needs may not come up in the same way, shape, or form going forward. I know that was a lot of an update, but I'm happy to take any questions you have on anything that we've covered this morning.
So Matt, first, thank you for putting together this example. This is exactly how I kind of philosophically was rolling around in my head. So nice to see a specific and clear example of it. So thank you for that. Any questions? Okay.
No, I agree. Very easy to understand.
This was something that Brent and I dreamt up on his conference room table, and we just got it, and it came through here. So just,
we go.
it's overly simplified, but hopefully it paints that picture in a way.
That's
And we will be in communication with the trustees if we do need to have that special meeting. And Sean or Mitchell will probably reach out to you if that is the case. But a lot of that comes down to the communication between the operators and the city entities that hold those operating agreements.
And when will we be receiving the applications?
So, excuse me, those will be going directly to those, whoever the city entity is holding it. So for instance, right now, I know that there are certain operators that have the form and they're going to fill out, and they're working with, for this particular one, it's the Oklahoma City Economic Development Trust. So in one of the next few monthly meetings, I believe Joanna, her intention is to have that on that agenda.
So there's not an established deadline for when they have to?
Not, especially not for this year.
Okay.
Now, going forward, when we have a more established process and we're fitting directly into the city's budget process, we will most likely have a stricter deadline. But with all the decisions that were made this year, for years 1 and 2 of the disbursements, I would imagine it will be more fluid.
And I do think that moving forward, in next year, I think it would be interesting to have this report for the 9 projects, just so that we can begin kind of tracking
What that
right,
looks
what
like
that
and
looks
the
like.
impact.
Yeah.
Absolutely.
Anything else? Great, Matt, thank you so much.
Thank you.
Great job. Okay, all righty. So moving on to item 4, comments from trustees, staff, and interested parties. Did we have any? No public comments, okay. Any comments from staff? Okay, any comments from trustees? Okay, so with that, we'll move on to item 5. We are adjourned. Thank you.